Neelkanth Mishra, Chief Economist with Axis Bank and Head of Global Research with Axis Capital. Neelkanth, good morning. Thank you for joining us.
Good morning, Nikunj. Always a pleasure being with you.
क्या दुनिया लग रही है आपको? What's your view of the world?
You started with, you're forcing me to start with a negative comment. So, no, I'm very worried about the world. I think the financial markets are ignoring some very meaningful risks. I'm just hoping that we are able to navigate them, and the regulators in the West are able to navigate them with some ease. So the biggest risk right now, I think, is the global cost of capital, the risk-free rate. The US Treasury yield, I think, is likely to spike up again when the world starts observing how bad the US fiscal condition is. And also the after effects of the crowding out that the US government is doing, which is driving significant dollar shortages in the rest of the world. So yeah, the global outlook still looks pretty bleak to me.
Why are markets ignoring this obvious risk? The fact that government balance sheets are getting bloated, they will find it difficult to sustain this kind of an debt servicing level. Interest rates are far higher than what they were 3 years ago. These are obvious concerns which perhaps are taught to you at a very elementary level when we read finance, but everybody is ignoring it.
So if you remember, this is in 2010-11 when the US Fed had given forward guidance that they would keep interest rates at zero for a sustained period. Even then, there was this disbelief that PE multiples on, say, some leading consumer names could be higher than 40, 45 times. If you went and told some of the domestic portfolio managers that buy this consumer company at 45 times earnings or 40 times earnings, they would have thrown you out of the room. And over the decade, the market became used to higher and higher multiples. So 40, 45 became 45, 50, then 50, 55, then 55, 60. And these days I see people trading stocks because they used to be at 80 times earnings and they become 70 times earnings and suddenly they become cheap. So this is something that the markets adjust to over a period of time. And in the interim, in the near term, it's all muscle memory. And the muscle memory is that if the Fed has stopped hiking, then it must start easing. And if they start easing, then automatically the global cost of capital starts coming down, and let's start piling on to the emerging markets. And within emerging markets, let's start increasing the PE multiples that we should assume for most of the stocks. And so I think the changes will occur over a period of time. I've often said that equity risk premium, which is the excess return that markets demand for risky assets like equities, is a discovered metric. It is not a modeled metric. So you don't really assume a certain ERP and then you start buying or selling stocks. It is something that, like progressively over I was also, like your previous speaker, in the US. In fact, after that, I was in the UK, then in Singapore. So I've had 3 weeks of meeting global investors. And what you hear is that progressively, I think the economic indicators in the US and elsewhere are actually weakening. I'm surprised people are ignoring that despite all the supply cuts, oil is back at $80. These are very negative signs for global growth, and therefore, as the surprises and the shocks start coming through, I think you will see the markets correct.
So Neelkanth, what would it spell for markets like India? And I ask this because in any case, the foreign investors have eluded us for a while.
So, see, I think the scenario for India continues to be time correction. There are 3 or 4 important variables to think about. The first is that the risk-free rate that we are used to is going to be significantly higher in the next 5 years than it was in the 5 years preceding the pandemic. So the US Treasury yield is not going to be 2.5%. It's most likely going to be 4.5%, if not higher. Which means that the PE multiples that we can justify 2 years out will be a lot lower than the PE multiples. It may not go back to the 13, 14 times that we saw in 2012-13, but it could be maybe 16, 17 times and not really 18 to 20 times the range that for the Nifty that people have gotten used to. The second variable is that the $30 to $35 billion of annual unintended flow of savings into equities. For example, for most of us paid in the formal sector, 2% of our salaries go into the Nifty ETF, right? So 12.5% standard deduction, 15% of that goes into Nifty ETF. You add to that the SIPs, the insurance flows and all that. There is $35 billion of flows where people are not trying to time the market. It's just habitual and those flows keep happening. So India's premium to the world will remain elevated. The third important variable is that the Indian economy is doing better than expected. In fact, earlier in January, there was almost a competition among forecasters that how low can you take India's GDP growth, right? So there were economists who were talking about 5% growth or 5.5% growth. Thankfully, the consensus is now closer to 6.5%, and I think the current run rate is well above 7%. So the economy is doing better than expected, and therefore earnings are actually behaving very well. And that's the last point. The muscle memory of the market is that earnings will keep getting cut. If you remember, in all of the previous decade, if the Nifty EPS started at 100, over the 2.5 years that a Nifty forecast lives for, right? So about a month back, we saw FY26 Nifty EPS come up. It'll last for about 30 odd months. Over these 30 odd months, there would be a 10 to 30% cut in the Nifty EPS. So every 3 months, you were losing 2-3% because of cuts, and you were gaining 3-4% because of the roll forward. What has happened post-pandemic in the last 2-3 years, particularly as the economy has done far better than feared, the earnings estimate cuts are not happening. So that was the most remarkable takeaway from this quarter's results as well, which means that the roll forward now is actually driving significant gains. For all of this year, Nifty's performance has been driven by EPS upgrades or EPS gains, and which is mostly because of roll forward issues. And the PE multiple has actually declined. So I think the market performance is increasingly being driven by roll forward gains on EPS. And so I think that the Indian market will time correct. But whenever the global accident, which is necessary for the Fed to find a valid reason to start buying government bonds again or start expanding its balance sheet, that reason will be a severe one. And I think that will drive perhaps a temporary blip down in the markets.
The outlook when it comes to the kind of liquidity situation that we've been seeing, at least over the past few days, the FIIs have been buyers. But what is the sense that you're getting over the next year with the overall election outcome, etc.? How are you looking at liquidity?
So as I said earlier, this is a blip. This is muscle memory that people think that US Treasury yields fall off from 4.95% to 4.4%. And then emerging markets then become attractive, flows start happening. So if you assume, and if someone has an estimate that the US Treasury yield will keep falling or will say 3.5%, then yes, I think the flows can sustain and will happen. But if you think about the $2 trillion of annualized deficit in the US, fiscal deficit, and you see that dollar availability outside the US, as Neelkanth started off, we have all learned the theory that if the government's fiscal deficit is large, then the private sector gets crowded out. If the US government's fiscal deficit is large, the whole world gets crowded out. If you use a simple metric of broad money supply growth in the US, M2 growth, minus nominal GDP growth in the US, that is the most negative we have seen in the last 65 years. And which means that the dollars outside the US are getting sucked into the US to just finance and just to support its GDP growth. And which means that, say, take India. India, about 3-4 years back, even pre-pandemic, we could think of financing a $70 to $80 billion current account deficit because that was the nature of the capital flows. We are now, I think, going to struggle to finance a $30-40 billion current account deficit because net FDI, which used to be $45-50 billion, has shrunk by $20-25 billion. external commercial borrowings, which used to be a source of dollars, from a plus 15, 20, likely become -5. And therefore, there is a substantial reduction. And India is not the only economy facing that. Indonesia is seeing that. Every other country is seeing that. And this is not going to end because the QT is still continuing, quantitative tightening. Credit growth in the US is still negative, which means that money creation by the banks in the US, the dollar creation is also slowing down. And therefore, this will create, this has to break at some point. So I think the liquidity, and whenever it breaks, there will be another stampede to into US dollar assets. And so I think liquidity will worsen. Once we have passed that speed bump, then I think, and so that's when the Fed will have to come out and start expanding its balance sheet. And once that does, then the liquidity conditions ease, and then we can feel a bit relaxed.
Neelkanth, let's now address a few things where everybody wants to seek your opinion. And these are some of the consensus views in the market. One consensus view in the market is, and since you flagged off this whole issue of, of current account deficit, is that post-elections, we could see a change in liquidity, but more importantly, because of the JP Morgan bond inclusion, it's going to be a free flow into the bond market. Is that good enough to take concerns, at least on the CAD front?
Okay. Let's first understand why is it that the bond market is not sort of front loading before the index inclusion. I mean, in the equity markets, it is almost a business case now for predicting who will get included into the various benchmarks, and therefore the market buys those stocks, and then when the index inclusion actually happens, then they hand it over to the buyers, right, at a higher price. Why isn't it happening in the bond funds? And I think the reason is that people are quite wary of this whole issue I was alluding to earlier, that if US Treasury yields are going to be 4.5%, 5%, why do you really need to be in the emerging markets? And the quantity of dollars available itself. So if today there is $236 billion, that was the number when the index inclusion happened, will that number be $180 billion by the time the index inclusion actually happens? And therefore, the quantum of dollars that you can expect may not be that big. But I think the fact that those dollars are about to come in, and they are benchmarked, so I think some amount will come in, is actually one reason why I think India should be quite stable. I don't see the elections by themselves, I mean, really being that important. If you think about the direction of travel for the economy, the reason why the economic momentum is so strong is that after a 10-year downturn, the real estate cycle is starting to turn up. I don't think that will change because of any election result. And similarly, the $35 billion of flows into equities are also to a large extent behavioral and systematic. I mean, there's not too much of volition going into those flows. I don't think they are going to change as well. So this whole narrative that we should be, people will talk about it. If you meet investors, every meeting I had over 3 weeks across 3 continents, this issue came up, and I think we are perhaps overestimating the impact of that on flows and liquidity.
Neelkanth, the other thing is, and I don't know, I want to get your views here. The outsized bet that's worked so far this year is bet on urban India, the premiumization trend. That K-shaped recovery has played out only for, the Uber reach, and it's not really played out for the rural economy per se. Even right now, the trends and the data points that you're seeing don't really point to a meaningful recovery in the rural end of the economy. Is that a worrisome sign?
Yes, it is indeed worrisome. And it's particularly more worrisome because we don't understand why exactly that's happening. Because if you see strong cement volume growth, every indicator of construction activity has gone up, and you can't really, however much you may automate, you can't really build houses, build roads without employing a lot of construction labor. And if you remember the narrative at a time when construction activity did used to be strong, which is before 2012-13, it was considered the biggest employer after agriculture. So if construction activity is so strong, it is very surprising to me, and that the data points at the for say staples companies, the volume growth has been so anemic. And I can think of 3 or 4 reasons for this. All of them are contributors. It's very hard to conclude on how long they're going to last. The first is that perhaps we are looking at the wrong metrics. Because remember that in the bottom 50% of the population, which is what we are tracking through such metrics, brands are a luxury. And what happened during the pandemic is that the companies that used to supply, if you think about, say, rubber slippers, I mean, some people think that a 200 rupee rubber slipper from a particular listed company is cheap enough. Well, that may be cheap enough for you and me. But if you go to a local hut in a village, you can get a rubber slipper for 40 rupees. So the informal sector or the smaller manufacturers have come back. You must have seen the tax data analysis that 40,000 manufacturers in FY22 didn't file returns. And I think many of those are coming back, and especially as I think some of the listed companies have been a bit slow in cutting prices. So that I think is a very important driver of the fact that perhaps we are looking at the wrong metric, but that may not explain everything. I think the second factor is that inflation sensitivity is very high the moment you go into the bottom half of the pyramid. So some of the trackers that are Access Capital colleagues who cover consumer track show that FMCG baskets are 30% more expensive than they were 3 years back. And if you have that level of inflation, then obviously I think volumes will start getting affected, and which perhaps is also a reason why some of the smaller manufacturers are, I think, making inroads. We have also seen, surprisingly, a spurt in Narega demand, and that's something which is completely confusing, especially as it seems to be very strong in states where there is actually very strong demand for power, very strong demand for cement, very strong demand for cars and everything else. And it could be due to, some delays in processing of claims of Narega or whatever. But you're right, this is a problem that needs to be addressed as to if the rest of the economy is doing so well, why is it that staples companies are still struggling with volume growth? It could be an issue of timing as well, right? Just like a two-wheeler company today announced, and it's made front lines in your the paper from your house as well, that the rural recovery has been very visible, and two-wheeler registrations were up very strongly during the holidays and during the festive season. So, so it is possible that some of this could actually be backward-looking as well.
Now, last question, and again, something where the consensus view is that everything is going right for the banking sector per se. Credit growth is decent, NPAs are low, corporate balance sheets are not levered, so अच्छे नहीं, बहुत अच्छे दिन आने वाले हैं. But RBI has come out and has raised concerns about unsecured loan, which is the high growth area for them. So what happens because of that? Do you think assumptions they need to be revisited?
I thought you were also going to say that everything is looking well except the stock prices, right? So so the issue, I think, with unsecured loans is that so there are two segments in that group. So the total outstanding as of end of FY23 was about 10 trillion rupees, right? So it is not a very substantial part of the overall. It is growing very rapidly, and therefore perhaps RBI is right in sounding out caution and then increasing risk weights and telling the banks to be extremely careful. This is a new market. This is a market that is still developing, and therefore I think it's very important for the banks and the NBFCs themselves to be very cautious. But as I said, there are two parts to it. There are banks that are issuing unsecured loans, which are much larger in ticket size, and there are NBFCs and fintechs, which are also issuing these loans, but they are generally smaller in ticket size and larger in number. The signs of NPAs and stress have now started emerging in the fintech and the NBFCs, but as a percentage of overall loan book, they're a very small number. So if you are, say, 6% of the overall book, and even if you have 5 or 6% of distress or stress, then you're talking about a 0.4% of distress, which itself is not, I think, worrying enough. And for all the data points that we've gathered, it does not look like the bank's loan books on this front are seeing any distress. So most of the new to credit customers, customers which don't have any credit score, credit history. So in a way, the way the system is evolving is that you have a very strong core of existing customers, and or where there is some credit history, where the ticket sizes are big and there is a much more better record of cash flows. And at the fringes, the NBFCs and the fintechs are expanding this market, trying to get into areas which were earlier supplied by informal credit. And there, perhaps some of the algos are not working and they need to recalibrate. So I don't see this as a systemic issue. This, you're right, is one of the major reasons why the financial stocks are looking like they are late cycle, whereas on every other metric, as you mentioned, they are early cycle. So this remains a big overweight for us.
Question more like a tactical question. I'm sure you must have been asked this question directly or indirectly when you were in UK and Singapore, that should one chance their arm to increase allocation ahead of the election cycle, because that could be a 15-20% volatility event, or it is better to come 10-15% higher with a 5-year view once the election cycle is decisively over? When this question has been put in your front, how are you answering that question?
So if there is volatility around election results, either way, I think it's going to be very short-lived, right? Because the economic momentum is very strong. In the 2-3 year horizon, I think the central government's role is not that meaningful. It matters significantly for macroeconomic stability. It matters significantly for geopolitical strategy, for some very large sector reforms. But that matters over 5-7 years. If you're thinking about 2 to 3 years, what matters is state governments. What matters is the inertia that is brought along because of the bureaucracy, which there is a certain way in which the permanent part of the government works, and that is very hard to change very quickly. So when you think about some of these things, the revival in the real estate cycle, the fact that there's a lot of unintended flows that are going into equities, it's very hard for me to envisage a scenario where you see a very volatility that lasts, right? So you could see 1 or 2 days of volatility. But as investors who are trying to invest in India for its medium-term growth potential, my advice would be not to try to time the market around elections.
All right, that's the advice coming in, and good to have you on board to get in your perspective across the board for the overall market trend.